and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here at the Norges Bank Investment Conference in Oslo, Norway, and these are your top stories. Mark Carney wins the Canadian election, promising to build a stronger Canada and fight Donald Trump's trade war.
President Trump is trying to break us so that America can own us. That will never, ever happen.
The U.S. president said to ease some tariffs on automakers as he marks 100 days in office. China urges other countries not to give in to what it calls a bully. Plus, a big beat for HSBC and record trading revenues at Deutsche Bank as traders cash in on market volatility. Now, we have some interviews, great interviews, with the chief executives of Ferrari and Norsk at this hour. Later in the morning, we'll also be joined by the Goldman Sachs chief executive officer, David Solomon. Now, first thing is first, as always, let's check on the markets, especially on these big markets day. Not only do we watch the election, of course, in Canada, but we watch what Donald Trump will do next. Now, again, quite a lot of economic data coming up. Actually, for the moment, stocks in Europe posting some pretty modest gains. You can see futures also gaining some 0.3%. Look, traders await two things. First of all, progress in trade negotiations, but also a series of updates in the U.S. economy. When you look at European earnings, let's get to the European markets map. There's a lot of focus on Deutsche Bank, HSBC, those shares rising, BP actually slumping after cutting its buybacks as profit missed estimates. Again, investors really tracking a big stream of data for clues on the health of the American economy, but also on the prospects for Fed interest rate cuts. For the moment, there's relative calm returning to the markets after some pretty extreme volatility that we saw on Liberation Day, April 2nd. So on to Canada. And Mark Carney is promising to work for all Canadians after narrowly winning an election dominated by trade tensions with the U.S. Now, the Prime Minister's Liberal Party is on track to win enough seats to form at least a minority government. Carney, a former central banker, is promising to stand up to the U.S.
When I sit down with President Trump, it will be to discuss the future economic and security relationship between two sovereign nations. And it will be with our full knowledge that we have many, many other options than the United States to build prosperity for all Canadians.
Now, for more on Canada and Mark Carney, let's bring in Rosalind Matheson, our EMEA News Director. Ros, thank you as always for joining us. So what are Carney's main priorities when it comes to trade discussions with the Trump administration?
Well, for a start, we need to know exactly what kind of government we're going to be having in Canada, because whether it's a minority government or a majority government may give us a sense of Mark Carney's wiggle room at home, whether he has to liaise with other parties on all of his policy making. But certainly he's setting out his stall pretty much straight away when it comes to the relationship with the US and the need, as he said, to renegotiate as well from the Canada end on the trade side, not just be responding to whatever is coming from Donald Trump in the minute when it comes to tariffs and trade with Canada as a whole. I mean, Canada's in an interesting position because on the one hand, they have leverage with the US because the US relies on Canada for a bunch of key materials, including raw materials. On the other hand, you know, there aren't that many other markets for Canada for some of these goods, so they also are at risk there in terms of their diversification. So what we're going to see is, can Carney develop the kind of relationship with Donald Trump that we've seen some other leaders do, where Trump respects the space a bit, where he's willing to negotiate and listen? And, you know, does that involve Carney standing up to Donald Trump? Of course, we saw Justin Trudeau, the previous Prime Minister, repeatedly attempt to stand up to Donald Trump, and that really not being a successful strategy. But will Carney have better luck? Certainly we're going to see an effort very early on in this administration to try and reset that relationship.
Ross, meanwhile, Donald Trump is also looking at softening some auto tariffs. What do we know about that?
Well, that's right. And of course, we're marking 100 days of the Trump administration, and Donald Trump is giving a big rally today in Michigan. This is the heartland of the U.S. auto sector, and certainly one where he's had a lot of big companies, auto companies, coming to him and saying what you're doing is going to be risky for us and risky also, for our staffing levels in the US. And he's very attuned to not having an environment where US auto workers are worried about their jobs as he's going to talk to the auto sector about his 100 days in office. And this is one area where he's very much seemingly listening to what the companies are saying. So what we're hearing is he's going to offer some tariff relief to the auto sector, which means they can get some money back for tariffs paid on foreign parts they bring in, and on a tapered basis. Eventually it will run out, but also they're going to try and avoid stacking tariffs when it comes to the auto sector. This is one area where all of his things collide. The US voter, how Americans are feeling about the economy, and a key part of the US economy.
Thank you so much, as always, Bloomberg's EMEA News Director, Rosalind Matheson. Now, China's foreign minister is also warning countries against caving into U.S. tariff threats, saying it'll only embolden what it calls a bully. Wang Yi's comments at a BRICS meeting in Brazil underscored China's attempt to portray itself as a bastion of free trade. Well, Alan Wang, our China economy and government editor, joins us now. So, Alan, when you look at Wang Yi's comments, does it mean that, China is now wants to be the leader of the free world?
That's certainly what China wants the world to see it as. But the truth is that the comments are coming after the U.S. claimed that Chinese President Xi Jinping called Trump, and China having denied having any trade talks whatsoever with the U.S. So Wang Yi's comments could be seen as a way for China to say that they're now rushing into any negotiation. In fact, just an hour ago, the foreign ministry, the department that Wang runs, gave a regular press conference saying that it welcomes dialogue only on the basis of equality and mutual respect. So that means that China's public position has been quite consistent in that China doesn't like the U.S. pressures and threats, and while it's happy to engage in talks, there are some conditions attached to it.
Alan, Trump's threats also seem to have given Xi Jinping a boost. Tell us more about today's big take.
So we have talked a lot about the economic aftermath of and the ramifications of all the Trump tariffs. But one thing that's rather unexpected is how politically the tariffs are actually handling China something that money can't buy. It's giving President Xi Jinping more time to fix his economy by basically giving President Xi Jinping a tool to rally the entire Chinese population around. So the U.S. has framed its trade war as a way to right what it sees as unfairness in its trade with China. But China has framed it as a full-on economic attack on the country. And this coming just, a couple of years after China's rising discontent with the COVID lockdown, as well as the general weakness in its economy. This new idea of a foreign enemy is allowing the Chinese government to blame everything basically on external pressure. So another key element in this is that by having Trump as a common enemy, this also solidifies Xi Jinping's control over the population and even its long-term rule. And this is important also because, unlike the U.S., China doesn't have the kind of democratic elections that we have every once in a while. And maybe China will see this as an opportunity to just weigh out the threat and use this time to reform its economy, to put it on a better footing, and to meet any external challenges.
Alan, thank you so much. Alan Wang there, Bloomberg's China economy and government editor, and I urge everyone to go and check out today's big take. Now, we're also joined by Johanna Kyrklund, Chief Investment Officer at Schroders. Johanna, thank you so much for doing it. I'm sorry I can't be with you in London. A lot of the talk here at the Norges investment conference is, of course, on inflation, what the Fed does next, some of the concerns out there, and what it means for portfolio managers. Johanna, what do you see as the biggest risk, actually, for portfolios that they could get wrong in the next couple of months?
Well, right now, the biggest thing we need to focus on is the risk of recession in the United States. So before Liberation Day, we saw pretty much no probability of a US recession because the labour market was so strong and because corporate balance sheets were solid. Clearly now, with the uncertainty created by the tariffs, we need to start pricing at least a probability of a US recession. So I think for now, the biggest focus we have as we look at data and analyse each company, we have to look at it stock by stock. We're really looking for that risk to growth is the first concern. And of course, thinking about the US versus other countries, the challenge of the US specifically is they could also be dealing with a bit of an inflationary shock at the same time. So that is the most imminent concern right now. Further out, what's the other thing that can cause bear markets is a rate shock. And right now, the US 10 is behaving itself. Trump typically has stepped back whenever he has worried the Treasury market, but that's probably the medium-term concern as we go into 2026. But for now, it's growth that I'm focused on.
So, Johanna, how many cuts, if any, are you expecting from the Fed? And we're getting a lot of data out of the U.S. Are we going to see, is this a turning point? Do you position your portfolio slightly different as we get onto Thursday and Friday?
Well, for now, we think the Fed is right to sit on its hands because the data isn't there yet to support a rate cut. Typically we have faded aggressive rate cuts. We've had a few times where we've had aggressive pivots priced in the recent years. And ultimately, we are dealing with a worse trade-off between growth and inflation that does muddy the water for the Federal Reserve. But as the year progresses, we do expect a bit of a slowdown at this point. And then, yes, we could see some rate cuts. But generally, I'd say we're still a bit above the market in terms of our rate cut expectations.
Johanna, what are you seeing in earnings overall? When you look at some of the things, for example, in tech that's coming up, banks, do they give you confidence that a lot of the companies can weather this, or do they need to do a little bit more for shareholders to get them back on side?
Well, I think the good news is we've moved from the first phase, when Trump first announced his tariffs, you had that sort of air pocket and that's typical of the market. When you're confronted with a new risk, you're trying to work out how to price it. We're now moving to a much more constructive phase where we're starting to understand the different reaction functions of the players involved in this tariff war. And that allows us to then think about the impact on companies stock by stock. Big picture, in terms of what the companies are telling us so far, they're not giving us much guidance beyond the next 90 days. So I think the reality we have to face is we're still dealing with a lot of uncertainty at stock level.
Do you think the aggressive move, I have to say, out of U.S. assets has been overblown?
No, generally, we have also been favouring European assets over US assets. This is something we started doing actually in December. To some extent unrelated to Trump. It was just a recognition that we were now very heavily, if you're exposed to the MSCI World, the exposure to the US was just incredibly high, and we felt that there was a need to start diversifying our exposure. And I think that first the DeepSeek news in January highlighted that innovation does exist outside the United States. But then more recently, the actions of Trump have sort of undermined the credibility of the US as a partner. And I think that, again, highlights the need to diversify portfolios. So generally, we're still playing that theme predominantly via Europe. So we're long European equity versus US equity, and we're favouring the euro over the dollar. Generally, and this is for the first time in years, because we've been bullish the dollar for many years, we always saw it as a positive carry hedge in our portfolios. We actually short dollars now, and that's literally, we haven't done that for years.
John, in Europe, how do you play equities? Is it sector-wide? Is it tech stock versus luxury stocks, or any exposure to China, or do you just do it geographically?
No, from the top down, we're really making that geographical allocation. And what really got us more interested in Europe, really at the turn of the year, was this idea that the debt brake might be released. The fact that actually the return to positive yields is hugely positive for Europe. Negative yields was a terrible environment for the European banks. That was really the main reason why we invested in Europe, because we saw the potential. We felt it was such an unloved market, and we saw the potential. We felt the environment had shifted quite a way in Europe. Typically, Europe acts when its back is against the wall. But now I think, so as I said, initially conviction was on the European side, but I think now also we see reason to diversify out of the US.
What do you do with China?
China's a bit harder because, of course, it's at the epicenter of the tariff war, and we need to recognise that there's still that's really the axis where we have the most uncertainty. We're neutral in China. We're not taking a view either way. Obviously, one thing we've seen since the beginning of the year has been a turn in the government's reaction to the market. It's been much more supportive of the equity market in a way that it hadn't been in previous years. So again, the interesting thing is that Trump's policies, in some sense, are leading to more stimulative policies elsewhere outside the United States. So that means that for now we stay neutral in China. I think the fact that the government's more supportive would certainly mean that we wouldn't want to be underweight, but we need to recognise that this is probably the absolute epicenter of tariff uncertainty.
Yeah, and Johanna, for me that seems the hardest, right, is figuring out exactly how stimulative some of these policies are from the Trump administration for the rest of the world, combined with the fact that maybe markets are not fully pricing in a trade war that could last for years. There seems to be an assumption, despite market volatility, that it will be okay, and I don't know whether you need to push back against that.
Yeah, I think that look, I mean, the market, it has attention deficit disorder. It can't focus on anything for too long without fresh news. I think that, as I said, for now there's potential for stability just because we had that air pocket and now we're getting to a point where we can start to price the risks. Bigger picture in the medium term, the thing that I'm probably watching the most, where I still don't have enough information, is the reaction of the European authorities to all of this. How are they going to interact with the US, and might the US try and force them to sort of freeze out China as well? I think that is still to come and something we need to watch out for.
Johanna, thank you so much for joining us. Johanna Kyrklund, their Chief Investment Officer at Schroders. Now, coming up, we'll have plenty more from Oslo, Norway. We'll be looking back on the U.S. president's first 100 days in office and discussing the effect of Donald Trump's policy so far. I'm delighted to be joined by Eivind Steenis from Oliver Wyman. That's next, and this is Bloomberg. Welcome back, everyone. Now, President Trump promised a market boom like no other if he was elected president. Instead, his first 100 days in office have fueled the worst stock slump since 1974. Now, the S&P 500 down about 8% since his inauguration. The dollar has slumped. Treasuries have lost their haven status as the Sell America trade gripped markets and recession fears grow. Well, we're now joined by Eivind Steenis, partner and vice chair at Oliver Wyman. Hugh, as always, thank you so much for joining us. Look, the market actually also quite sanguine. I mean, you have these ups and downs, but you know, they're quite level-headed, maybe too level-headed, some investors say, about what we've lived through with the Trump trade policies. What do you think history will look back on, this period in history, and tell us?
Well, thanks for having me on again, Francine. Look, I think this, as all investors know, this has been an incredibly challenging period. I think in some ways this is the biggest shock to world trade since 1971, when Nixon also put in import tariffs. And I think the market is really trying to weigh up, you know, how much of this first opening salvo will actually follow through. And I think that's the challenging thing that markets are trying to work through. We've already seen the administration pivot, probably 4 or 5 times. And so there's an assumption we'll get through this. But I still think the underlying change to supply chains could be very radical. Yeah,
and I guess you have like second round effects when you look at, for example, some of the small companies, how they fund themselves, some of the loans. What's not being talked about that chief executives are worried about?
Well, look, so from our conversation with finance, it's the cash flow crunch to small businesses, which isn't really getting on the front pages. Yeah. Obviously, large businesses can navigate, you know, through bumps and drops so well. There was a Pulse survey that I came across 2 weeks ago that 1/3 of small businesses have cancelled all their orders from international because they simply can't pay the tariffs. Because if you're let's say you're a small toy provider, you know, buying from China, you've got to pay 2.4 times the working capital, and you simply don't have that. So I think the squeeze on small businesses is really the big story, which hasn't really fully got out there. But you're starting to see through some of this dirty data, like the shipping to Seattle and to LA, some of those cancelled orders are starting to come through.
I mean, Hugh, I guess there's a working assumption that a lot of chief executives will also just stop spending for the moment until they have clarity on the situation. But there's also an assumption that when you look at the trade and tariffs, that it'll work itself out. Yeah. I mean, do the two balance each other?
Yeah, I mean, look, it's very clear from our conversations that CEOs have gone into defence mode. They're thinking more about trimming costs, but, they're not wanting to they want to keep a cool head because they don't, this is a very fast evolving situation. and day by day or every 3 days there's a sort of a new announcement. But no, they're very much in defence mode. They're very cautious, therefore, about costs. They won't be hiring as much, maybe pushing some plans to the right. And that's one where, obviously the vast majority of bosses are trying to just look through to the longer term, as Nicolai and you were talking about this morning.
I mean, it does probably have some, policy implication from both governments and central banks in terms of what they do to support their economy. How much of that is a benefit to, for example, small companies?
Well, so I think this is where the interesting thing about the changes in the States and what it's actually catalysing internationally, whether it's Canada, the UK, Europe, you're starting to see plans where where governments are looking that they're going to have to deploy capital domestically. And obviously in Europe we've also got a defence move. I mean, that $1 trillion from Germany has been a profound impact to the European yield curve. And, I think, you were talking with Nicolai about the long term. Remember, we had 8 years of negative rates in Europe. If we can now say that is behind us, I was very struck with Deutsche Bank's results this morning. Best quarter for 14 years. And I think that speaks to the fact that in the longer run, a steeper curve is incredibly helpful to the financial system, even if the growth shock is not.
So it depends, I guess, on on where you sit in the financial spectrum. Because if you do a lot of M&A, then this is probably, or IPOs, this is not your time. If you're an equity trader, you're probably having a great time.
Oh, look, I think this is everything, everywhere, all at once, as you're commenting everyone every day. I think, no, obviously, for the transactional businesses, pens were put down probably actually about 6 or 7 weeks ago, to be honest. And obviously, any pens which hadn't been put down got completely put down 4 weeks ago. And so I think, for issuance for IPOs, for M&A deals, the bid-ask is just too broad, and therefore deals are being pushed to the right. But it's interesting. Some of our conversations are people are hoping that they might pick up in the autumn, but there's some who are a bit more cautious. They're now saying, you know what, actually we may not get this picking up till the second half of 26 or even the first half of 27.
Hugh, what about private equity? Because it's difficult to price things at the moment, so it's difficult to sell and buy, but there could be longer-term opportunities.
Yes, so I mean, again, big sector to call, but there's a lot of indigestion in the system. I think, so many private equity firms had hoped for an exit this year, which has obviously been pushed to the right. Where I think there are some opportunities is around the private credit side, where you have seen some dislocation, not huge, but a little bit, and that's therefore thinking about opportunities to deploy that capital. But it's the fundraising environment, I suspect, will become a little bit tougher from here.
So you've worked very closely with Mark Carney through the Bank of England. You know him for many years. What kind of Prime Minister do you think he'll be?
Oh, look, I'm thrilled for Mark. Look, I think he's got a remarkable combination of strategic nous, economic savvy, and a very cool head in a crisis. And I was honoured to serve him for 18 months. And it's very clear that I think he's a great candidate for, great Prime Minister for this environment. Look, as we discussed, if this is the biggest shock to world trade in 50 years, having someone with that understanding of economic history and that network, I think will be Canada's very fortunate to have him. I mean,
could you see a rapprochement between Europe and Canada, or because of the retrenching of the US, or does the US come back?
I think there's only one person who knows that, and it's in the White House. Look, I think the lesson from the 70s, interestingly, was that Canada did put their elbows up back then too, and actually within 4 months the tariffs will pretty much drop to zero. And so I think there's a hard negotiation to be had. As you know, the big proportion of the deficit with the US is actually energy, which supplies the electricity for the eastern seaboard and other parts of the western seaboard. So the only other source of oil is Venezuela, which I think is even more persona non grata. So I think there's a good negotiation. I think Mark's a great person for that.
Hugh, I know you also have your pulse on UK business and UK companies. How's it going at the moment? Again, the UK was hit by 10% tariffs. Some say, look, it's so much better than others, but it has quite a lot of other shocks or concerns that it has to deal with.
So I think the UK is less impacted by the tariffs than many countries because we're a more service-based economy. Oh. In fact, if you had actually done the regression, we should have probably only had 3 or 4% export tariffs. No, I think the agenda there is much more about the current government and the financial situation. I think it's unfortunate that a series of steps have put more friction in the system. And certainly the businesses we talk to are worried about the new labour laws, the new taxes, the capital flight of some of the wealthier people. So I think there's some headwinds. But look, it's still a great place to invest. And so like anything, it's finding the right companies.
Hugh, thank you so much. Eivind Steenis, their partner and vice chair of Oliver Wyman. Now, coming up, look, we have some great interviews. Later this morning, we'll be speaking to the Goldman Sachs chief executive. He is David Solomon. That's at 10:30 a.m. London time. We'll talk to him about markets, trade, Europe. Also coming up, the chief executive of Norsk joins us here as the aluminium supplier cuts its outlook. We'll get more on the impact of U.S. tariffs next. And also, I'm looking forward to speaking to Benedetto Vigna from Ferrari. The chief executive also joins me from Oslo, Norway. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here at the Norges Bank Investment Conference in Oslo, Norway, and these are your top stories. Mark Carney wins the Canadian election, promising to build a stronger Canada and fight Donald Trump's trade war. The U.S. president set to ease some tariffs on automakers as he marks 100 days in office. China urges other countries not to give in to what it calls a bully. Plus, a big beat for HSBC and record trading revenues at Deutsche Bank as traders cash in on market volatility. Now, later this hour, we'll be speaking exclusively to the Ferrari chief executive, Benedetto Vigna. Also coming up, more, of course, on the Spanish power supplies. They're back to near 100% capacity as the country slowly returns to normal following a massive electricity outage across the country and in neighboring Portugal. Well, Bloomberg's Laura Milan joins us now from Madrid. So, Laura, what's the situation right now, and what do we know about the cause of what happened?
Most of the power is back in Spain and Portugal after the massive blackout that impacted most of both countries yesterday, but we still don't know what caused almost 2/3 of the Spanish power supply to go offline almost immediately in just 5 seconds. We still don't know what caused what the grid operator is calling oscillations in frequency or in voltage. It's not clear right now. Prime Minister Pedro Sánchez appeared last night, said that the technicians were working on finding the cause of the outage, and we expect the government, which is meeting at the moment, to come out later this morning and to speak to the press. We hope that we will have some more answers then, but right now we just don't know what caused the outage yesterday.
I mean, it's quite extraordinary. Laura, thanks so much, Laura Milan there in Madrid. Now, on to some corporate news. Norsk has reported adjusted EBITDA for the first quarter, missing estimates. It's lowered also its 2025 outlook for the extrusion divisions. Well, we're now joined by Eivind Kallevik, Norsk chief executive. Mr. Kallevik, thank you so much for joining us. Look, there's a lot of trying to figure out what kind of impact the tariffs have, what kind of impact it means in terms of demand. I know there's a lot of uncertainty on the tariffs, but what impact concretely have you seen this quarter?
So far this quarter, impacts have been very minute. When we look at the order intake for the first quarter and into April, they actually look quite good. So I think the jury is still out, and we'll see later on in the second and the third quarter what the impact is going to be.
Yeah. I mean, when you look, I think, at North American demand for extruded aluminium, it was down by 4%. Again, is that tariffs?
No, we don't think it's tariff-driven yet. Again, the bookings that we see into Q1 and into April are still quite good. And then, interestingly, we can shift around production from both our Canadian plants as well as the Mexican plants into the U.S. plants. And we see the fact that we have a unique production system also means that we can replace some of our competitors' volumes potentially coming in as imports.
When you look at some of the domestic order books in the U.S., does that improve?
So when we look year over year, so compared to 2024, we have a somewhat better order intake at the tail end of Q1, and also the numbers that we see so far in April.
Where are you seeing a likely drop-off in imports? Again, if you just walk us through what you're expecting in the next couple of months and then maybe in the next 6 to 8 months, that will give us an indication of how you're thinking of things.
So clearly with at least what we know as of today, there will be tariffs on imported parts from globally, so to speak. So the more you can manufacture domestically in the U.S., it's good for companies like us who actually have a large manufacturing presence in the United States to avoid paying those tariffs.
If demand for some of the aluminium actually continues at 4% downwards, what kind of implication does that have for your future earnings?
So clearly, in a recession case, that would mean lower sales, which again will be translated into lower earnings. And then we will adjust our production capacity accordingly to that. That's something that we can do when we have more than 20 sites across the North American region to adjust it to produce where it's most optimal at any point in time.
Mr. Kallevik, when you look at some of the alumina pricing, again, does it mean that you could shift, for example, towards the recycling or other things? When you look at where we are now, and again, there's so much uncertainties, but does it change on where you want to be stronger?
Yeah, so we have the flexibility. We're one of the largest recyclers of aluminium. We're also one of the largest primary producers of aluminium. So we have the flexibility to shift between recycling versus the primary portfolio that we have. We do that partly in Europe. In the US, we're mostly based on recycling. That scrap we buy domestically in the US for domestic sales in the US. So in many ways, we're insulated from the tariffs on aluminium input in the United States.
When you look at scenarios and where the world economy is going through and inflation in general, what do you think your base assumption should be?
I think these days it's incredibly hard to make very clear predictions for the rest of 2025. We see tariffs are changing pretty often, leading to uncertainty. So again, what it requires from a company like ours is the agility and ability to adapt to the situations that we see, while at the same time staying true to the strategy we have towards 2030. Obviously, increased tariffs will at some point also lead to increased inflation, and then we can all estimate or guesstimate, if you like, what that will do to inflation and inflation levels in the United States or other places around the world over time.
Eivind, thank you so much. Eivind Kallevik, there, the chief executive there of Norsk Hydro. Now, coming up, we'll have plenty more, of course, on some of the earnings, on some of the banks, HSBC, also Deutsche Bank. In a quarter marked by intense volatility, Deutsche Bank reported record revenue from its trading desk. Now, fixed income and currency trading surged 17% as the Trump administration's policies continued to add uncertainty into markets. Now, for more, Oliver Crook is in Frankfurt, fresh from a conversation with the Deutsche Bank CFO. Ollie, what do these results actually tell us?
Yeah, Francine, I mean, it's what we saw across a lot of the trading desks across the United States and the rest of Europe is that basically the intense volatility in the first half of the year was really a boon for all of these traders that were operating in the first quarter. We saw it, as you said, about 3 billion euros worth of revenue for Deutsche Bank from the trading desk. That is a record number for them, up 17%. But what's interesting, Francine, is that an investment bank is not just the trading desk, right? There's another side of it. There's the M&A, there's the deal side of things. Intense volatility is not good for that side of the business. That is what we also saw in the first quarter, and we saw the same thing illustrated in the first 2 weeks of the second quarter as well. But Francine, what I thought was really interesting in talking to James von Moltke is that this intense volatility isn't actually always good for the trading desk. In the first 2 weeks, the 2 weeks after Liberation Day, we saw these massive breakdowns across the market. That was not a good week for a Deutsche Bank trading desk. They were really focused on getting prices, the correct prices to their clients, getting liquidity out to their clients, and making sure things didn't break when correlations were breaking down left, right, and center. And that is just the implication within the market. I also talked to James von Moltke about the longer-term assessment about whether or not the U.S. is still the safe haven that it once was, and how much of the damage that the Trump administration has done, how much of that is permanent. Here's what he had to say.
Our analysts are calling for a relatively significant structural change. I do think that will take time. It's had a pretty dramatic impact on the euro-dollar exchange rate already, and a further drift, up from here would be impactful overall. I think the difference you're seeing is that the policy changes are making the rest of the world interesting to investors and changing the relative position a little bit of the United States and Europe.
So they're the message from James von Moltke that really seeing a rebalancing away from those U.S. assets. Really a beneficiary for that would be the German Bund, of course, and the euro, but really sort of spreading across the rest of the world, to say nothing of the fact, Francine, that for Deutsche Bank, when you think about all the bad news that has been priced into the German economy over the last couple of years, the tariffs, of course, adding to that, there's actually €1 trillion of spending that is coming down the pipeline. Maybe that is not quite priced in, and something that Deutsche Bank could really benefit from over the coming years.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on Deutsche Bank. It was a great conversation. I think we're going to put the whole thing online. HSBC has also announced a $3 billion share buyback after first quarter profit came in well above estimates. Let's get more on that and today's other earnings from Charlie Wells. Hey, Charlie, HSBC, what you got?
Hi, Francine. So we've got so many earnings dropping, and we really do need to start with HSBC because they had that profit beat and that significant $3 billion buyback, $1 billion more than people had been expecting. And this is just a vote of confidence, not just in this bank, but in the banking sector, in Europe in particular. You can see in the Euro Stoxx 600, this is the best performing group. And year to date, they are outperforming a number of their United States peers. So again, a vote of confidence, and you're picking up on that in that buyback. I'm talking about buybacks, and I've got to talk about other earnings. Buybacks in focus with BP. They reported a disappointing set of earnings today and a disappointing buyback figure. I got to bring this up here. $750 million. The hope from investors, from analysts, had been that it would be in the billions rather than the millions. This is the lower end of that guidance, but we just know that BP has been under pressure because of that oil price. I'm talking about oil. I'm also going to talk about oil pipelines. That makes you think that. You think about pipelines, think about the drug pipeline. AstraZeneca's drug pipeline had been giving it a lot of optimism this year, a lot of optimism going into this earnings report, but that's not being met in the market. They were able to beat on a number of fronts, but the market just does not like the sales figures that they posted, at least at this point this morning. We've also got the threat of pharma tariffs looming over this industry, looming over this country. And if we're talking tariffs, we've also got to talk autos. A lot of auto companies reporting this week. Porsche reporting this morning, and a disappointing set of earnings there. They issued a profit warning. They said that their profit margin is likely to slip this year. And this is a company that is so exposed to tariffs because they have no production capabilities in North America. Now, saying you've got an imported European luxury vehicle is great on that luxury shop front in the United States. It's not so great in the middle of a trade war.
Yeah, it's not. We'll see what Ferrari does. I'm looking forward to our conversation, actually, with the Ferrari chief executive, Charlie. That's coming up shortly. Coming up, our exclusive conversation, of course, with David Solomon of Goldman Sachs, and exclusive with the chief executive of Ferrari, Benedetto Vigna. We'll talk tariffs and the outlook as the company prepares to roll out its first fully electric model. That's next, and this is Bloomberg. Welcome back, everyone. Now, the head of Norway's $1.8 trillion sovereign wealth fund says real estate and renewables are becoming more attractive in the face of stock market volatility. Well, I spoke to Nicolai Tangen, the chief executive officer of Norges Bank.
In a way, the world is splitting into two. And that means that we probably will see lower growth, and there is a risk that we will see higher inflation. And so the market is very resilient, given that backdrop, I think.
So, which means that you're expecting maybe a correction? And are there parts of the markets that seem too sanguine at the moment?
Well, we've been saying for quite some time that we think it will be more difficult to make money going forward. And so I suspect with all the uncertainty that we are seeing just now, that we could continue to see, tough times. So
what's it like being in the markets? Do you worry? Is this an opportunity? What does it mean for how you position your portfolio for long-term investment?
Well, I think the way to behave in the market now is just to be broadly diversified and very, very long-term. You really need to put your long-term hat on. And I think to do, tactical reallocations and movements is very, very difficult because they move so fast. When we last met in Davos, it looked like the US was going to be fantastic from a stock market point of view, and Europe, all the leaders we met from Europe were really, really depressed. Well, you fast forward a couple of months, and the whole thing is just turned upside down. So it's very, very difficult to get these turns right.
But, and Nicolai, what does it mean longer term? Because actually it's unclear where the trade barriers exist, whether market pressure will make the Trump administration do a U-turn. So even 3-4 years, visibility is extremely difficult.
Yeah, no, absolutely. We really don't know how this is going to pan out. I think what is certain is that the long-term trend of globalization, growth, these kind of things, that will look very, very different going forward. So the easy money is not there anymore.
You have over, I think, 50% allocation into U.S. assets. Does that change?
No, we are very happy with our U.S. allocation. We have, big holdings in Treasury, and we have, big holdings in the large companies in America. They are great companies, and we love owning them.
Well, that was Nicolai Tangen, the chief executive of Norges Bank Investment Management, speaking to me a little bit earlier. Now, on to a great exclusive, because President Trump is on track to ease the impact of his auto tariffs. That's what we found out today. Now, changes include lifting some levies on foreign parts for cars and trucks made inside the U.S. Now, while imported cars would also be given a reprieve from separate tariffs on aluminium and steel. Well, Europe's car industry is looking at ways to respond to the auto tariffs, with Ferrari announcing plans to raise prices for some of its cars in the U.S. by as much as 10%. Well, we're now joined exclusively by Benedetto, Vigna, Ferrari's chief executive. Benedetto, this is the interview that everybody wants to know about, because they want to know about the new cars, the great things that you'll put in place. But first to tariffs. Yeah. How much of the cost can you pass on? I also need to say you're in a quiet period because your earnings will be on May 6th. So I know investors will have to wait a little bit more for any concrete update. But how's it feeling?
Look, I think that we as a company are used to manage situations that are changing. We are having this situation change with the tariff. I think we've been pretty quick. Already 27 March last year, we said three things. One, all the cars that are important before April 2nd, no price increase. Two, some cars like 296 SF90 and Roma Spider, no price increase also if you place an order after 2nd of April. And three, yes, there are some cars that will have an increase up to 10%.
But so, is Ferrari immune? Because, I know the waiting list is long.
The waiting list is covered well into 2026. But apart from immunity of Ferrari, I think there is one important message that I would like always to remember, to myself, to all the team. The customer is the client is at the center of what we do. We have to respect the client, because if he places an order, well, we have to consider the condition and we have to respect him.
You also said, which I found fascinating, Ferrari is not a midlife crisis car. No. Because you're selling much more to the younger generation.
Indeed.
Does that look differently in terms of what they want, how fast they want it?
You said it. You framed it much better than I did. But it's true. There are many. We have a lot of new clients. I was chatting with a client, 32 years old, just last week. He was very pleased because he placed an order for the 296 GTS. So we keep having, and we see more and more youngsters, he and she. Men and women.
Also changing.
Yeah. It's especially in new countries, but it's not only there. We see also that the traction of Formula One is attracting more and more people in our world. So that's good news. Yeah,
and we could have a whole conversation about Lewis Hamilton, but maybe for another time. When you look at everything that's happening between the U.S. and China, does it change, again, the demographics on where the cars are sold and bought?
We don't see this. We don't see this change, honestly. We see China today. We are selling double the number of cars we were selling pre-COVID. We see, U.S. as we announced in the last quarter, 1 over 4 cars is going to U.S. So we don't see. What I can see instead is the new countries popping up. Eastern Europe, take Czech Republic, take Poland, but also Korea, Taiwan. So these are countries where we see a growing interest in our car.
And this is what for the hybrid? Because I know there's also an exciting update today in a couple of hours for the 296. I don't know whether it's fully new or different.
That's the reason why you pick up this date.
Yes.
No, in a few hours you will see the latest born of our new Ferrari. We said that this year is a special year for us because we will have 6 new cars on the road.
Big year,
yes. In line with our plan of Capital Market Day, by the way. So nothing different. We keep the things under control. And this will be the first 2 cars of this 6-year deployment. This will be, you will see.
Okay, I'll see.
Wait a few more hours and you will see everything about those cars.
I know, everyone will tune in, Benedetto, but is the market share of that, I mean, that's really increasing, right, this hybrid car. Is that what you're expected to just go from strength to strength in terms of market share or in terms of the amount of cars that you sell within the group?
But, look, the number of cars we sell more or less are in the range of 13,000, 14,000 cars. That's what we have been selling. We see 50-50 between ICE and hybrid. I think it's important in line with our strategy that we offer the client the opportunity, the freedom to choose. So far, they can choose among hybrid and ICE. Mm-hmm. In the future, they can also decide if they want to pick up an electric car.
I know. I keep on trying to get you to give us a little bit of news on the electric car. Can you give me something?
What I can tell you is that we will announce this car in October. And as we like to do innovation in the product, we like also to do innovation in the way we launch the car. So I will tell a little bit more about this car in a few days during our quarterly call. But we are on track with our plan. And we are looking forward to have a richer product portfolio to offer our client.
What are you most excited about? You've had so far a very good year. Is the
very
tariffs?
Good, yes.
Is the tariff something that you just need to work around, or
look, the tariff is a change of the condition around us. In the past, since I am in Ferrari, we had many changes. Now we had the chip shortage, then we have the Ukraine war, then we had also the Middle East war, and consider that some of our suppliers were over there. So we had to manage also the situation. Nobody thought about that. This year, the challenge is called a tariff. I mean, we are managers. We have to manage what is under our control, and we have to adapt. I think that's the beauty of life. That's the beauty of business, no? That keeps you busy.
If you like a challenge. If you don't like a challenge, not so much. But it seems
I took this challenge.
and you seem ready, I have to say, to,
I think that, we have been, this company had always this clear in mind. You have to be ready for the challenge. It's like when you drive a car. You don't know when things happen. When you are, I was in Imola last weekend, at the hypercar, okay? When you see there is an accident, there is a situation that you have to face, you have to be agile enough to face that situation.
I mean, there's a bit of a softening, actually, from the Trump administration on tariffs today for cars.
It seems so today. I mean, we like to wait when things are official, because look, we stick to what we said on March 27. When we invoice the car, that was a great idea I think we had in the company. We isolate on the invoice this part. If things change, we'll revert back. I mean, it's simple.
From a business perspective, could this be a new golden era for Europe if they get through it? That actually there's a proposition that Europe can go head-to-head with the U.S. in certain places?
I think that when things change, people have to change. I think that what I see, I'm talking about the European supplier that we have. I see that recently, I see more and more European suppliers that are becoming aware of the need to increase the pace and to offer something unique. So if, let's say, 2-3 quarters ago, I was them more in a wait and see, now I see more reactive. And I am very proud about that, because we can have more innovation also stemming from them.
Benedetto, I know there's a lot of speculation about what kind of, not tie-up, but what kind of conversations there are between Leapmotor and Ferrari. What can you tell us?
This is interesting, because I read it on the internet. I got a lot of message. Well, I would like to remind 3 things that are important for our brand. 1, in Ferrari, we don't use platform. 2, we don't buy platform from outside. 3, we always keep in-house strategic components. In electric car, the component that the blog was referring to were strategic, so this will be always under our control.
Is there something there? Is there something else that you can work on?
I think that we have some Chinese supplier, yes. Are they making strategic component? Not. I think that there is nothing more than that. Sometimes also because of my past experience in semiconductor business, I have also a relation with people that were my previous client. So the people start to make stories that are not true.
When you look at China, how do you see the China demand? I mean, we're expecting a lot more help from the government. How do you see China going forward, especially when it comes to EVs?
First of all, when you go to China, and I've been pretty often in the last years, you don't hear the car when they're getting close to you, so you have to pay attention when you cross the street. But I see that the new technologies, let's say the approach of the Chinese people toward new technologies It's different from what I see in other countries, in other continents. So this is good. I see also a lot of the pace of development of innovation over there in these new technologies is higher. And this can become a push, a boost also for the Western world, I think. So that is good. In terms of demand, as I said, the number of cars we sell now is double the number we were selling before the COVID. And, we also need the Chinese people to get more acquainted with our brand. The number of Ferrari we have in China is 10,000 cars since the beginning of history. If you go in other countries, it's 80,000, 90,000. So.
Benedetto, I mean, the only really important question is Ferrari. Does it have to be a red car? I know you sell, yellow, green, all kinds of colors, but what's the Benedetto color?
The Benedetto color I'm driving now is red.
Of course.
But in future, I may take something more on the bluish side.
And blue, we're keeping our options open.
Yeah, this is like my
viewers are thinking like a blue. What kind of blue?
It's blue like this. I like a lot this kind of blue.
Navy blue.
Yeah.
There you go. It's a bit like Batman vibes. Benedetto
No,
Vigna.
not Batman.
Not Batman. Someone else. Benedetto, thank you so much for joining us. Benedetto Vigna there, the Ferrari chief executive. Now, coming up, we'll have plenty more, of course, from the Norges Bank. We'll also be speaking exclusively to the Goldman Sachs chief executive officer, David Solomon. We won't talk about the color of Ferraris with him, but we will ask him about inflation and what the Fed does next. That's at 10:30 a.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.